golden on the outside, rotten on the inside. Wow, that's a pretty harsh way to describe a company, right? But that's exactly what one analysis said about our topic today. So in this deep dive, we're going to find out if there's any truth to it.
All right, so we're diving into the upcoming Hong Kong IPO for Guoxia Technology. Now, on the surface, this thing looks great. It's got all the buzzwords: high growth, booming industry, you name it. But our job today is to peel back those layers, look past the slick marketing, and really see what's going on underneath.
So here's how we're going to break this down. First up, we'll compare the story they're telling with the reality of their business. Then, we'll dig into some pretty serious financial red flags. After that, we'll look at governance and some major dependency risks. And, of course, we'll analyze the deal itself, the valuation. Finally, I'll give you my final verdict and how I'm thinking about a subscription strategy. Okay, let's jump right in. First section, what exactly is the story Guoxia wants us, the investors, to buy into? And let me tell you, it sounds pretty good. They've branded themselves as the intelligent major domo for energy. It's a cool concept, right? Think of it this way. They're not just selling you a big battery. They're selling you a super smart system, powered by AI that figures out the absolute best time to suck up cheap electricity and then sell it back to the grid when prices are high. It's a really compelling high-tech pitch. But is that what's really driving their business today? And that brings us to the reality of their business. Because when you look under the hood, you see it's really a tale of two totally different strategies. And they've made this dramatic pivot that frankly changes everything. Okay, take a look at this table. It tells you pretty much everything you need to know. Back in 2022, these guys were all about selling residential battery systems overseas. Think high margins, cash sales to distributors, a pretty sweet deal. That was over 72% of their business. Now, fast forward to 2024. That part of the business has just collapsed. It's barely 10% of their revenue. So what's replaced it? Boom. Large-scale domestic projects, now making up a whopping 76% of sales, mostly to big Chinese state-owned enterprises. So let's be crystal clear here. This isn't just some small business pivot. This is a complete 180-degree U-turn. They've traded a business model of quick cash sales for one where they're dealing with massive projects and waiting and waiting and waiting to get paid by incredibly powerful clients. And honestly, understanding this one shift is the key to unlocking all the problems we're about to see. Which brings us perfectly to our next section, the financial red flags. It's time to look past that flashy revenue growth number and see if we can find some skeletons in the closet. I mean, just look at these two numbers side by side. On one side, you have this mind-blowing 660% revenue growth. Absolutely incredible, right? You'd think they'd be swimming in cash. But then you look at the other side. Their operating cash flow is a massive negative 205 million RMB. They are just burning through money. So the big question is, how is that even possible?
Well, this quote just nails it. It's a classic case of paper wealth. The analysis uses this fantastic term, hemorrhagic expansion, like the company is literally bleeding out just to get that growth. They're booking all these sales, creating this wealth on paper, but the actual hard cash, it's just not coming through the door.
And if you want to know why they're burning all that cash, well, it really comes down to this one single number, 181.8 days. Yeah, that's the average time Guoxia had to wait to get paid for its products in the first half of 2025. We're talking half a year. And that's up from just 56 days back in 2022. It's tripled. This is the direct consequence of that big pivot we talked about. They're now dealing with huge state-owned companies that are notorious for taking forever to pay their bills. Guoxia has basically become a bank for its own customers, and it is draining them dry. Oh, but it gets worse. It's not just their cash flow they're sacrificing to win these big domestic deals. They're also killing their profits. Look at this. Their gross margins have been sliced in half, plunging from a healthy 26.7% down to a razor-thin 12.5%. This is the textbook definition of chasing growth at any and all costs. All right, so we've established the financials are shaky, to say the least. But what about the company's structure? Let's talk about who's actually in control here and some of the extreme dependencies they have. You know, the composition of a company's board can tell you a lot. And here, 2/3 of the board are insiders, people who work at the company. Only 1/3 are independent. What does that mean for you? It means the founding team has absolute control, and there's very little outside oversight. And that, my friends, is a big risk if you're a minority shareholder coming in through an IPO. And this is where things start to look really, really precarious. The company is basically walking on a tightrope. Think about it. Almost 80% of their revenue comes from just 5 clients. And get this, one single client, Client H, made up almost 42% of their sales recently. It's the same story on the other side, too. 75% of their supplies come from just 5 companies. They are completely squeezed in the middle and have almost zero bargaining power.
At the very center of all this dependency is this really complex, kind of murky relationship they have with a company called Kalb. Okay, let's try to untangle this. Kalb is a shareholder in Guoxia. They are also a critical supplier to Guoxia, and they are a major customer that buys systems from Guoxia. You see the problem? This circular flow of business and money raises huge questions about whether the pricing is fair and if these are really independent deals. Okay, we've seen the business pivot, the cash burn, the dependency risks. The fundamentals are shaky. So that brings us to the billion-dollar question. Is the price for this IPO even remotely right? Let's break down the deal. This is just wild. Look at this valuation explosion. In 2022, the company was worth about 20 million RMB. Then, in its pre-IPO funding round, it suddenly jumped to 6 billion RMB. And now, for the IPO, they want us to believe it's worth over 10 billion RMB. That's a 500x increase in just a couple of years. You have to ask yourself, is this company really 500 times better than it was? Based on everything we've just seen, that is an extremely tough sell. So let's put that number into context with its competitors. Guoxia is asking for a price-to-sales ratio of 6.3. Now, let's look at their more established peers on the mainland A-share market. You've got Goodway at 1.6, Hyperstrong at 4.6, Sungrow at 4.1. So Guoxia wants a huge premium compared to them. And that's before you even remember that Hong Kong stocks usually trade at a discount to A-shares, not a premium. The pricing here just feels completely disconnected from reality. And then there are just some other weird things about the deal itself. The main sponsor, Everbright, doesn't have a great track record with recent IPOs. The group responsible for supporting the price after it lists, the Green Shoe, is being managed by a smaller co-lead firm, which is a bit strange. The only real upside people are talking about is this hope that if the price jumps 20%, it can get into this thing called Stock Connect, which would let mainland investors buy in. And maybe the strangest thing of all, why on earth are there almost 20 underwriters on this deal? It just adds to the feeling that something is off. So we've dug through the story, the financials, the risks, and the deal structure. It's time to put all the pieces together and give you my final verdict. All right, here's my take. For me, this is a small, speculative bet at the absolute most. Look, there are rumors floating around that there's market support lined up to prop up the price. But even if that's true, and even if you get that 20% pop to qualify for Stock Connect, that's probably your best case scenario. That's the ceiling. And you have to ask the hard question. If it doesn't pop, who are you going to sell your shares to? Who's going to want to buy into these fundamentals? It's just a really tough spot to be in. And so that really leaves us with the one big question you need to ask yourself. On one hand, you have an insane valuation, collapsing profit margins, and a business that's bleeding cash. On the other hand, you have this speculative hope of a quick 20% gain if it gets into Stock Connect. So the question is that hope really enough to make you overlook all of these massive flashing red flags? That's the decision you've got to make.